So far, 2022 has been a pretty bad year to begin investing in the stock market. As time goes on, people are starting to talk about an approaching recession, and it might just happen. Although it's too early to tell if the rest of the year will be as chaotic as the first half of 2022, it's very likely that it'll fall into the same fate. Factors such as calamities, inflation, and high oil prices are pretty solid signs of an upcoming recession. But if there's one thing that you should know as an investor, it's that you can always find a hidden opportunity to make millions during a recession. Hey, welcome to Stock Market Mate. Today we'll talk about the top 3 recession-proof dividend stocks to buy in 2022. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. The current global, financial, and political conditions are presenting indicators of an impending recession. Investors are concerned about a possible recession due to inflation and economic stress brought on by the Russia-Ukraine conflict. According to a report published by Wall Street Journal in May, analysts have estimated a 28% possibility of a recession in the coming year, up from an 18% probability analyzed in January. Rising interest rates typically damage technology stocks since investors are reluctant to put their money towards risky investments. Moreover, the crypto market has lost about $1 trillion in value so far in 2022, despite the largest sell-offs in history. Because of this, investors frequently resort to dividend-paying companies, which have the potential to offset the effects of volatile and tight market conditions. Number 3. Dividend Aristocrat stocks. Dividend aristocrats are dividend growers that consistently increase their operating profitability and cash flow. Companies that achieve this consistent success, especially in volatile, low-growth markets, suggest that they have specific financial qualities and corporate discipline. Investors are drawn to these companies because they have a long track record of consistent performance, higher earnings quality than the broader market, and the ability to boost dividend payments year after year while maintaining a consistent payout schedule. Some of these names include companies that consumers know and love, such as 3M, Coca-Cola, Colgate-Palmolive, Genuine Ports, Hormel Foods, Johnson & Johnson, Procter & Gamble, and Tootsie Roll Industries. The performance in both bull and bear markets has been strong, and investors are looking for certainty in this volatile time. In 2008, Dividend Aristocrat market performance fell approximately 22% while defending shareholders' dividends, compared with the S&P 500 slump of 37%. According to the performance of consumer staples like Johnson & Johnson, Coca-Cola, and Procter & Gamble, Dividend Aristocrats continue to have strong thick and thin records. Putting together a high-quality dividend-growing portfolio can be simplified by adding Dividend Aristocrat exchange-traded funds, as these types of funds have a mix of large, mid to small-cap companies from different industries. Experts suggest investors should approach selecting Dividend Aristocrat ETFs the same way they choose any other type of ETF. A few examples of Dividend Aristocrat ETFs include the ProShares S&P 500 Dividend Aristocrats ETF. With an expense ratio of 0.35%, the ProShares S&P 400 Midcap 400 Dividend Aristocrats ETF with an expense ratio of 0.40%, and the ProShares Russell 2000 Dividend Growers ETF with an expense ratio of 0.40%. One thing to look out for when it comes to dividend ETFs is the expense ratio or the fee charge for managing the fund attached to it. Overall, one strategy to multiply investments over time is to invest in high-quality companies. That is why you should always consider aristocrats. This variety and consistent income increase add longevity to your portfolio. High-quality companies that have reliable cash flows and have raised dividends throughout the last financial crisis are more likely to survive and thrive in the present economic environment. Dividend-paying stocks will attract investors who are aiming to reduce volatility. As an investor, focusing on a dividend growth strategy with aristocrat stocks will provide a beneficial buffer against market volatility. Number 2. Closed-end funds. CEFs, or closed-end funds, are actively managed mutual funds that trade on a stock exchange. CEFs can be a valuable addition to a diversified portfolio, delivering both income and capital appreciation. CEFs can be traded like stocks because they're typically listed on a major exchange such as the New York Stock Exchange, which provides the benefit of intraday liquidity for investors. They also provide investors with one-of-a-kind investment opportunities. The closed structure allows portfolio managers to access a broader opportunity set, including less liquid investments that offer high income and return potential. Moreover, they improve your income potential through leverage. CEFs can borrow money to increase exposure to investments with the goal of enhancing income and capital appreciation potential. Some CEFs out there performed well this year, and many investors saw their share price fall over 20 to 30%. Because of this, plenty of these investments are currently offering incredibly high dividend yields, and it's not that common to see most of these funds offering yields of 11 to 13% or more. To add to this, many closed-end funds in the market pay monthly dividends to shareholders. Take the Guggenheim Strategic Opportunities Fund as an example. They're currently yielding at 12.55%, and according to Google, they also pay a monthly dividend of 18% per share. Closed-end funds have been around for more than 100 years, so you can bet it's been tested and proven to yield good investment outcomes. If you're considering a CEF, review its prospectus to understand how the yield is determined. Number 1. Real Estate Investment Trust or REIT. Smart investors are stocking up on recession-resistant assets, such as real estate investments, which can help offset increasing inflation, diversify their portfolio, and hopefully weather the storm when it arrives. If you're planning to recession-proof your portfolio, then you should consider investing in real estate industries. While real estate is a sector that tends to hold up better than most during recessions, there is a wide range of subsectors that can be affected in different ways. For example, real estate investment trusts that own hotels don't tend to perform well in recessions, as consumers spend less money on travel. On the other hand, there are several types of commercial properties that are extremely resilient and should perform just fine even in a tough economy. If you're looking for a REIT that's built for any type of economy, then you should look into Realty Income. Realty Income has the best overall dividend stock in the market. If you're not familiar with it, Realty Income has grown from a single fast food restaurant building in 1969 to a portfolio of more than 11,000 single-tenant properties in the US and Europe. The REIT has made 622 consecutive monthly dividend payments to investors, has increased its payout for 98 consecutive quarters, and has delivered 15.3% total returns to investors annualized since 1994 NYSE listing. It may seem strange that Realty Income fares so well during recessions, given that the majority of its tenants are retail. However, the majority of premises are occupied by recession-resistant businesses, such as grocery stores, convenience stores, pharmacies, and dollar stores, to mention a few. Realty Income delivers a 4.4 dividend yield in monthly installments, and this income stream is expected to rise for many years. If you're looking for extremely resilient properties that offer excellent income, then Healthpeak Properties is the best choice. It's difficult to argue that commercial real estate is more recession-resistant than healthcare. Simply explained, healthcare tenants have long-term lease agreements, and people require healthcare regardless of the state of the economy. In a recession, Healthpeak Properties might be a particularly smart investment. Life science facilities, medical offices, and continuing care retirement homes are the three categories of properties it invests in the healthcare sector. As the enormous baby boomer group ages, all three are recession-resistant and should continue to rise in demand for the foreseeable future. With a 4.1% yield and plenty of room for growth, this might be an excellent rate to purchase in both good and bad times. But if you're looking for a practically indestructible rate, then Digital Realty is our best bet. Not even a recession can topple this trend. The volume and sophistication of data traveling throughout the world are continually increasing. This is unlikely to decrease even in a recession. And all of this information needs a home, which is where data centers come into play. Digital Realty is one of the world's largest data center owners and operators, with some of the most well-known technology companies among its clients. True, Digital Realty's business may decrease during recessions as tech businesses reduce new spending, but the long-term trend remains intact. With a dividend yield of about 4% and a share price nearly 30% below its peak, Digital Realty is a terrific rate to consider if you are afraid of a recession. Overall, we can only hope that this volatility slows down soon. But for now, you can use today's content as an inspiration to bet your money and collect some of the largest dividends in the market. Just don't forget to diversify your portfolio across different sectors, and always perform your own research. With that being said, we're wrapping up today's video. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!